If you're choosing between SCHD and VIG in 2025, you're essentially deciding between higher dividend income now and steady dividend growth for the future. But which ETF is actually better for building long-term wealth? Stick around, because by the end of this video, you'll know exactly how these two compare and which one may fit your investing style the best. Welcome back to Asset Index, where we break down ETFs, dividends, and passive investing strategies to help you build long-term wealth. Today's video is all about SCHD versus VIG, two of the most popular dividend ETFs on the market. On the surface, both look like solid choices, but the truth is, they are built very differently, and your results will depend on your goals. So let's start by understanding what each ETF is designed to do. Section 1. SCHD Overview. SCHD, or the Schwab US Dividend Equity ETF, is often seen as the king of high dividend yield ETFs. Launch and popularity. It launched in 2011 and has exploded in popularity thanks to its balance of yield and performance. Dividend yield. As of 2025, SCHD's dividend yield is around 3.5% to 4%, depending on market conditions. Holdings. SCHD holds around 100 stocks, focusing on companies with strong dividend track records. Think of companies like PepsiCo, Cisco, Home Depot, and Broadcom. Index methodology. It tracks the Dow Jones US Dividend 100 Index, selecting companies with at least 10 years of consistent dividends, and screens for fundamentals like cash flow and return on equity. What makes SCHD special is its quality screen. It doesn't just chase yield, it looks for financially strong companies that can sustain and grow their dividends. Performance. Historically, SCHD has delivered around 11–12% average annual return since inception, which is very competitive, even against broader market ETFs like VOO. So, with SCHD, you're getting higher income today, without sacrificing too much growth potential. Section 2. VIG Overview. Let's shift to VIG, the Vanguard Dividend Appreciation ETF. Launch and legacy. VIG is older, launched back in 2006, making it one of the first ETFs built for dividend growth. Dividend yield. Its current yield is lower, around 1.9% to 2.1%. So much lower than SCHD. Focus. Instead of yield, VIG prioritizes dividend growth consistency. It tracks the S&P US Dividend Growers Index, which requires companies to have at least 10 years of consecutive dividend increases. This means VIG is filled with companies that may not pay as much today, but have a strong history of growing their dividends year after year. Holdings. VIG is more diversified, with around 300 stocks. Top holdings include Microsoft, Johnson & Johnson, Visa, and United Health Group. Notice the difference: these are blue-chip companies that reinvest heavily in growth, while steadily raising dividends. Performance. VIG has historically returned about 9 to 10% per year since inception, not as high as SCHD in recent years, but with a very stable growth trajectory. So while SCHD leans toward higher income, VIG is more about slow compounding dividend growth. Section 3. Head-to-head comparison. Now let's put SCHD and VIG side by side. Dividend yield. SCHD 3.5 to 4% versus VIG 2%, clear win for SCHD if your goal is immediate passive income. Dividend growth. VIG historically has higher annual dividend growth rates, often around 8 to 10% per year, while SCHD's dividend growth is closer to 7% on average. So if you're patient, VIG's smaller dividends today could catch up over decades. Holdings concentration. SCHD is more concentrated, 100 stocks, while VIG is broader, 300 stocks. This makes SCHD more targeted and sometimes riskier, while VIG spreads risk wider. Sector exposure: SCHD leans heavier on financials, industrials, and energy. VIG is overweight in technology, healthcare, and consumer staples. So SCHD gives more income-heavy sectors, while VIG has more growth-heavy exposure. Risk and volatility: SCHD has slightly more volatility due to concentration and cyclical exposure. VIG is steadier, but with lower payouts. Section 4. $100,000 portfolio example. Let's run a quick example. Imagine you invest $100,000 in each ETF in 2025. SCHD at 3.7% yields about $3,700 in annual dividends today. If reinvested and dividends grow at 7% annually, that could double your income stream in about 10 years. VIG at 2% yields about $2,000 in annual dividends today. But with 9 to 10% annual dividend growth, those payouts could grow much larger over decades. So, if you're near retirement and want income now, SCHD has the advantage. If you're younger and reinvesting, VIG's growth compounding might catch up long term. Section 5. Which ETF fits you best? So which one wins in 2025? Choose SCHD if you want a higher dividend yield today, plus exposure to financially strong US companies that have a solid balance of growth and income. Choose VIG if you value stability and long-term dividend growth, even if it means lower income for now. The reality: many investors actually own both. SCHD provides income now, while VIG provides growth for the future. Conclusion: in the end, the choice between SCHD and VIG depends on your goals and time horizon. Do you want income to spend now, or income that grows steadily over decades? Personally, I think both can complement each other in a balanced dividend portfolio. And remember, at the end of the day, the most important thing isn't choosing the perfect ETF. It's sticking with your plan and letting compounding do the heavy lifting. If you found this breakdown helpful, subscribe to Asset Index for more ETF comparisons, dividend investing strategies, and portfolio building guides, all backed by real data.